We're here at the Global Alternative Investment Conference, and it's certainly an alternative investment to look to China these days. Jim, the last time you were with us, you told us that you were betting against virtually all of the large banks in China because bad loans would wipe out all of their profits. Has the government's move to buy shares in the banks today affected your thinking in any way?
No, not at all. Good morning. The Chinese Sovereign Wealth Fund that is increasing their stakes already at high levels, slightly more, did this as well in September '08, but ended up only spending about $300 million U.S. over the next 2 years. So we think this move is symbolic. I think people are taking some heart that the government's paying attention. But the fact of the matter is we believe that the Chinese banking system is incurring new bad debts at the rate of somewhere around 500 billion a year. So buying stock in the open market, if they really wanted to shore the banks up, they'd be buying stock directly from the banks.
So you don't think they are shoring the banks up? At this point, they're just trying to send a message?
I think they're trying to send a message. I think that's appropriate. Look, everyone knows that the Chinese government stands behind the banks. The Chinese government owns the banks. But we also know from the past two banking crises that China never really bailed the banks out. They simply had them transfer their loans to so-called asset management companies. The asset management companies then issued bonds bought by guess who? The banks. So sort of like me swapping my two $50,000 cats to your $100,000 dog.
Perella Weinberg has put out a new report that estimates that 25% of Chinese bank loans could be bad. I don't know whether it's higher or lower than your estimate, but they say it could be $1 trillion worth of bad loans. But because of China's reserves and because the government stands behind the banks, they say it's entirely manageable.
Well, remember, those reserves of $3 trillion have liabilities against them. When exporters earn dollars, they take them to the People's Bank of China and transfer those dollars for RMB. And there are liabilities against those dollars. So to think that you can simply use foreign currency reserves to shore them up is a little bit misleading. What that really means is the People's Bank would have to print currency to refinance the bank. And as you know, China has an inflation problem already.
So at this point, the Chinese government's move isn't causing you to change your investments?
No, the property market is what we're focused on, and the property market is slowing down dramatically. October sales, from everything we see, are every bit as slow as September's, which were down 50 to 60% versus a year ago. That is their big sales months, are September and October. I think that the property market is what investors ought to be watching because that drives everything in China.
The Hang Seng's down 21% this year. The Shanghai Composite 16%. Can you still make money, or have you made the bulk of what you can get?
Well, look, I think the property market is in the very first parts of a very serious pullback in China. And I think we're going to find out exactly just how poorly capitalized some of these developers are. So, I mean, I'm not really paying much attention to levels of the market. We're watching fundamentals in individual companies. And those are starting to deteriorate. And
so the property market there still has a ways to go.
We think the property market is just starting to decline. And the fact that people are even talking about the government stepping in to shore up the banks when 2 months ago people thought there was nothing wrong with the Chinese banks should tell you just how seriously this situation is deteriorating.
We got to take a break in about 30 seconds, but let me quickly ask you, I understand you've not been to China, but you're going?
I'm not going to China. I'll be going to Hong Kong in a few weeks and Asia throughout the region, but probably won't be stopping in the mainland.
What do you hope to learn in Hong Kong that you haven't already bet on now?
Well, I think we're actually talking to clients, and it's a trip to before year end to visit with clients and potential clients.
Jim, I want to start with you just on politics. We've been talking about the Republican presidential debate tonight. Now, I know you're a Democrat, but is there anything that the candidates tonight could say on the economics front that could perhaps change your mind or elicit even any type of support at all?
Well, I'm not sure any of the Republican candidates would say anything, Betty, that would change my mind. They seem to be doing a pretty good job occupying each other's time on these debates. So I think, look, the country's got some serious issues ahead of it. I think you've got an awful lot of anger still in this country directed at Wall Street and banking industries. Witness the demonstrations that aren't going away. But I'm not sure that the Republican platform is going to bring forth anything new tonight, Betty, but we'll see.
Well, you were one of the few prominent names in finance to attend Warren Buffett's fundraiser for Barack Obama the other night.
Yes.
A favor to Warren, or are you still a strong supporter of the president?
Well, I'm a strong supporter of the president, but I thought it was an interesting dinner. I went as somebody's guest. Warren actually had some interesting things to say about taxation and some of the other things about the wealthy paying a higher share, and I thought he did a good job. And I think that we'll have to see. Look, we've got difficult choices in 2012, and on jobs, on taxes, and it's not going to be easy for either party.
Well, a lot of people in finance have moved away from the president. What do you still get out of his administration that leads you to continue supporting him?
Well, look, I mean, a lot of people in Wall Street will back, whichever horse they think is in the lead, and it's not due to any conviction in politics. Let's be brutally honest about that. And I think, look, I think it's a sense of fairness. And one of the things that has bothered me, whether I'm on Wall Street or on Main Street, is that income inequality in this country is just getting worse and worse and worse. And that is not a recipe for stable economic growth when the rich are getting richer and everybody else is being left behind. And I think there are ways to basically solve that don't leave acrimony in the air. And but it's going to involve, I think, rich people paying more, and I think it's going to involve a cut in entitlements to look at what the Democratic Party holds sacred. I think that the Democrats are going to have to yield on that as well. I mean, I think Medicare is bankrupting us. So I think that both sides are going to have to give in. Unfortunately, that does not look like it's going to happen.
Very quickly, before we let you go, let me ask you about Europe. Can't short European banks.
Right.
Is there a way you're playing Europe at this point? What do you expect to happen?
Well, we were short the European banks going into the ban, so we've remained short. I mean, Europe is following the same model that we did in 2008 without the capital raising. I mean, they seem to continue to believe that the banks holding a lot of sovereign debt don't need to raise capital, and the fact of the matter is they do, and the market knows they do. We're going to see how the Dexia situation works itself out, but again, we have an opportunity here in a crisis to send a message that capitalism basically works, i.e. shareholders and bondholders in these troubled institutions should have to take a haircut or be wiped out. Depositors should be protected. And whether or not we see that happen or whether we see shareholders bailed out again, as we've seen over and over and over again, well, maybe we're going to get more demonstrations.
Jim Chanos, thank you very much.